Welcome to House Lux Estate, your go-to source for insightful, unbiased investment advice. We're here to guide you through the intricate labyrinth of investment strategies, unraveling complexities with data-driven insights and clear, actionable advice. At House Lux Estate, our mission is to shed light on the often overlooked nuances of investing, offering you the tools to navigate the financial world with confidence. Investing is a journey filled with potential pitfalls, and proper research is your compass, guiding you away from common errors and towards a secure financial future. However, even the most meticulous research can be undermined by our own cognitive biases. These subconscious influences can cloud our judgment and skew our perception of reality, leading us astray in our investment decisions. In today's video, we'll delve into a prevalent cognitive bias that often skews investment research: confirmation bias. Come with us as we explore how this subtle yet powerful bias can derail your investment strategies and learn how to safeguard your financial future against it. So, what exactly is confirmation bias? Imagine you're in a room full of puzzle pieces, each representing a piece of information. Now, say you're trying to put together a picture of a sunset, but you have a strong inclination that sunsets are always orange. You might unknowingly start picking out only the orange pieces, ignoring the purples, pinks, and blues that are also part of the sunset. That's essentially what confirmation bias is all about. Confirmation bias is a psychological phenomenon that describes our tendency to search for, interpret, favor, and recall information in a way that confirms our pre-existing beliefs or hypotheses. It's a subconscious act of bolstering our own perspectives, sidestepping any information that may challenge or contradict them. Let's put this into a real-life context. Say you're a big fan of a particular sports team. You might unconsciously focus on all their victories, their stellar performances, and conveniently forget about the times they didn't perform well. Or perhaps you're scrolling through your social media feed and you find yourself engaging more with posts that align with your political views, while disregarding or dismissing posts that express a contrary viewpoint. These are classic examples of confirmation bias at play. In the realm of science, confirmation bias can be even more misleading. A scientist, for instance, might favor data that supports their hypothesis and overlook data that contradicts it. This can lead to skewed results and false conclusions. But confirmation bias doesn't just affect our personal beliefs or scientific research. It also significantly influences our decisions, especially in areas like investment research, where the stakes can be high. Now that we understand what confirmation bias is, let's see how it affects investment research. Confirmation bias can significantly skew our investment research, leading to potentially costly mistakes. It's a psychological phenomenon that can have profound effects on the way we handle our investments. Let's dive in to understand how it operates in the world of investment research. Confirmation bias, in essence, is our tendency to favor information that confirms our existing beliefs or values. When applied to investment research, it can lead to some detrimental outcomes. One of the most common ways this bias manifests is in the overvaluing of our own research. We may spend hours poring over financial statements, market trends, and economic forecasts. And because we've invested so much time and energy into our research, we're more likely to trust it implicitly. However, this can lead to an overconfidence in our own conclusions and a lack of consideration for alternative perspectives or contradictory information. For instance, let's take a hypothetical investor. We'll call him Joe. Joe has done extensive research on a particular tech company and is convinced it's the next big thing. He's so confident in his research that he invests a significant portion of his portfolio in this company, ignoring advice from others who caution him against such a risky move. Unfortunately, Joe's overconfidence in his own research blinds him to the potential downsides of his investment. Another way confirmation bias impacts investment research is through the dismissal of contradictory information. We humans have a natural tendency to ignore or downplay information that doesn't align with our pre-existing beliefs. If Joe comes across a negative news article about his chosen tech company, he may dismiss it as irrelevant or inaccurate, choosing instead to focus on the positive information that supports his investment decision. This can lead to an incomplete understanding of the investment landscape and potentially to poor investment decisions. Lastly, confirmation bias can cause us to hold on to investments longer than we should. If we've made an investment decision based on our own research, it can be incredibly difficult to admit that we were wrong. This can lead us to hold on to losing investments in the hope that they'll eventually rebound, rather than cutting our losses and moving on. Let's go back to Joe. If his tech company starts to underperform, Joe might hold on to his shares, convinced that they'll bounce back. He may even double down on his investment, buying more shares at a lower price. However, this can result in significant financial loss if the company continues to underperform. As we can see, confirmation bias can seriously hamper our ability to make sound investment decisions. It can lead us to overvalue our own research, ignore contradictory information, and hold on to investments longer than we should. By being aware of this bias and actively working to counteract it, we can improve our investment research and make more informed decisions. But more on that in the next segment. Stay tuned. So, how can we overcome confirmation bias in our investment research? Just like a seasoned sailor navigating through the storm, we can steer clear of the whirlpool of confirmation bias. There are several strategies we can employ, and the first is seeking out contradictory information. This might feel like swimming against the current, but it's crucial. If you've formed an opinion about an investment, actively look for information that contradicts your beliefs. It's not about proving yourself wrong, it's about ensuring you've considered all angles. This approach helps to balance our perspective, making our investment decisions more rounded and robust. Next, let's talk about questioning assumptions. It's easy to make assumptions, especially when we are dealing with complex financial data and market trends. But assumptions can lead us astray. They can cloud our judgment and skew our investment research. So, challenge your assumptions. Ask yourself, what am I assuming here and why? Is there a different way to interpret this data? Is there evidence that supports an alternative viewpoint? By questioning our assumptions, we force ourselves to think critically and avoid falling into the trap of confirmation bias. Another strategy to overcome confirmation bias is taking a data-driven approach to investment research. Data doesn't lie. It's objective and unbiased. But here's the catch. It's not just about crunching numbers. It's about how we interpret them. We need to ensure that we're not cherry-picking data to support our preconceived notions. We need to look at the complete data set, analyze it objectively, and draw conclusions based on the full picture. Using statistical tools and techniques can be incredibly helpful in this regard. They allow us to analyze data in a systematic and unbiased manner, helping us to make more informed investment decisions. But perhaps the most important strategy of all is cultivating self-awareness. We need to acknowledge that we're susceptible to confirmation bias. It's a part of being human. But by recognizing it, we can take steps to mitigate its impact. We can pause, reflect, and ask ourselves, am I falling prey to confirmation bias? Am I seeking out information that only confirms my beliefs? Am I ignoring contradictory evidence? By asking these questions, we can keep ourselves in check and ensure that our investment decisions are based on sound research rather than biased beliefs. Finally, remember that overcoming confirmation bias is not a one-time effort. It's a continuous journey. It requires practice, patience, and persistence. But the reward is worth the effort. By overcoming confirmation bias, we can make more informed, objective, and ultimately successful investment decisions. By being aware of confirmation bias and actively working to overcome it, we can make more informed investment decisions. To recap, confirmation bias is a cognitive bias that can significantly skew our investment research. It's that pesky little tendency to favor information that confirms our pre-existing beliefs or values. And when it comes to investing, it's like a wolf in sheep's clothing, subtly nudging us towards decisions that may not be in our best interest. Today, we've taken a deep dive into the world of confirmation bias, exploring its impact on investment research. We've learned that it can lead us to overlook critical data, skew our analysis, and ultimately impact our financial outcomes. But fear not. We've also discovered strategies to overcome this bias. By actively seeking out contradictory information, questioning our assumptions, and maintaining a healthy skepticism, we can make better, more informed investment decisions. Thank you for joining us today at House Lux Estate. Remember, Always question your assumptions and seek out contradictory information to make the best investment decisions. Don't forget to subscribe for more insightful investment advice. See you next time.